Hello, my name is Daphne Kenyon. I'm resident scholar in tax policy at the Lincoln Institute of Land Policy. I would like to welcome you to a webinar that is part of our series called the School Funding Property Tax Connection. Today we will focus on South Carolina. As you may know, the property tax plays a key role in the funding of public education in the United States. In 2015 to 16, about 45% of total revenue supporting elementary and secondary education came from local governments, and 81% of that local share came from the property taxes. Put another way, over 50% of total property taxes in the US go to pay for K-12 education. Today we have a presentation and short Q&A presented by Laura Ullrich, with me serving as moderator. Before introducing Laura, I would like to instruct the audience to use Q&A for questions and to use the chat feature if they are having technical issues, such as sound problems. Looks like we're good. Let me introduce Laura. Laura Ullrich is a regional economist at the Charlotte branch of the Federal Reserve Bank of Richmond. Previously, Ullrich was Associate Dean for undergraduate programs and a professor of economics at Winthrop University. She earned a bachelor's degree in economics from the University of Georgia and a master's and doctorate in economics from the University of Tennessee. Her research interests include school finance reform, state and local tax and expenditure analyses, higher education, welfare policy, and the economic impact of local development. Laura, thanks so much for giving us a presentation on Act 388 and property tax reform in South Carolina. The floor is yours. Let me mute myself.
Okay, excellent. Thanks so much for having me here today to talk about it. As you know, this is something that I've been interested in for a long time, and so I love having the opportunity to talk about school finance really in any way, shape, or form, but especially as it relates to the property tax in South Carolina. So as Daphne mentioned, I will be focusing on what is known as Act 388, and I'll give some background on that, as well as property tax reforms in South Carolina as a whole. Since I am an employee of the Federal Reserve, I get to do this fun disclosure that reminds everyone that the views that I'm going to express are those of myself and don't necessarily represent the views of the Federal Reserve Bank of Richmond or the board in general. All right, so property tax reform in South Carolina. This story really goes back to about 1993. There was a school finance reform case filed in that year called Abbeville School District et al. Versus South Carolina, and it was a group of small, relatively low income school districts that sued the state, saying that there was inequity in funding in lower income schools. The property tax revolt really started gaining steam then, because it was anticipated that the plaintiffs would win in the case. As you'll see, it did not quite work out that way in the end, but in the beginning, that's kind of what people expected. So in 1995, there was a homestead exemption that was passed that year that eliminated school property taxes on the first $100,000 of market value of owner-occupied homes. It's important to point out from the beginning that we are talking about South Carolina, where home values are lower than in many other parts of the country. So in 1995, the majority of homes in the state of South Carolina were under that $100,000 mark. So for the majority of owner-occupied homes, they were no longer paying school property taxes for operating expenditures. Then in 2000, they also reduced the motor vehicle assessment rate from 10.5% to 6%. And then for a while, there wasn't a lot of movement in the property tax until about 2005. And if you think about what was happening overall in real estate markets at this time, they had been booming, especially in the coastal parts of South Carolina. So namely, if you think about Charleston, Myrtle Beach, those areas. And those property values began to increase. And so an anti-property tax movement gained a lot of steam. And in 2006, what's known as Act 388 was passed. And I'm going to go through all the parts of that. But long story short, it reduced tax rates in some ways, limited tax rate growth in others. And the main thing was it was a movement away from property taxes to the sales tax to fund schools. Fast forward to 2014. Finally, there was a verdict in that Abbeville School District case from 1993. It bounced all around the court system, and in 2014, the Supreme Court ruled in favor of the plaintiffs finally, stating that South Carolina had failed to provide a minimally adequate level of education. There then, as you can imagine, was a lot of conversation about what would need to change in order to, because of that ruling. But before any of that really happened in 2017, there was some turnover in the Supreme Court justices, and they suddenly vacated that 2014 decision, so, and ruled in favor of the state. So as of right now, the finding was for the state in that case, and so there were no major changes that occurred. And towards the end, I will talk about kind of where we are now and what some of the suggestions are moving forward. So back to Act 388, this law had several different provisions. I'm going to cover some of them here. The main provision was a tax swap. So that homestead exemption that existed on the first $100,000 value of a home was extended to the full value of the home. So in short, owner-occupied homes were no longer subject to the school portion of the property tax. Rental homes, vacation homes, apartments, not included in this, only owner-occupied primary homes. And in addition, commercial properties did not receive the exemption. In exchange for this reduction in property tax, the state sales tax was increased from 5 to 6%. And from the beginning, the messaging was that that increase in the sales tax would more than make up for the reduction in property tax. At the same time, they also eliminated the sales tax on food, so that on unprepared food, and that began in November 1st, 2007. South Carolina, those of you who have any knowledge about our sales tax system, we have an unusually large number of exemptions that exist, and we actually exempt more potential sales taxes than we collect in sales taxes. And this includes things from an exemption on sales taxes on porta potties, to wrapping paper, to textbooks. It's all over the place in terms of what is exempt. And we also have a very low cap on motor vehicle sales taxes. It's now $500. It was $300 until 2017. And so if you buy, a relatively nice used car, your sales tax is going to be $500. If you buy a luxury automobile, it's going to be $500. If you buy a Learjet, it's going to be $500. So these are on any sort of motor vehicle across in the state. So we're known for already having a large number of exemptions. So taking away the sales tax on unprepared food was a big deal because it limited the tax base significantly. And it was already limited to begin with. A couple other things that were in the law, there was a constitutional amendment passed along Act 388, which limited the property tax assessment growth rates to 15% over any 5-year period. An exemption was made for homes that sold during that period, so there was point of sale assessment for any homes that sold. So as you can imagine, this can result in horizontally inequitable property tax liabilities. If you think of a neighborhood where you kind of have two identical homes next door to each other, one's assessment growth is limited, but if the other one sells multiple times over that same period, they could have very different assessments over time. And then the property tax rate was capped, and it was capped at a rate of growth equal to inflation plus population growth. So they were only able, if you had inflation, let's say of 2% and population growth rate of 1%, then you could raise property taxes by 3% that year. If school districts failed to raise rates in a given year, so if you forewent that 3% raise, you weren't able to catch up in the future. So you had the opportunity to raise it that much each year, and if you lost a year, you just lost that opportunity. Overall, strong population growth in South Carolina made this more of a minor issue, although there are places in South Carolina, just like we have across the country, where population growth is shrinking. And that is more likely to be in the rural parts of the state. So in those parts of the state, they are limited to tax rate growth equal to inflation each year, which, as you all know, has been low in recent times. So the reality of the tax swap, this graph, I really like it because it shows kind of what happened in the years that followed. In 2006, lawmakers did argue while they were trying to get this law passed that there would be an $84 million surplus in 2009. However, there was the recession in the meantime, right? So some of this maybe was an ideal policy in terms of how it was written, but a lot of it also was bad timing, quite frankly, because it was passed in 2006. And then the next year, obviously, the recession began. And so you can see in that 2007, 2008 school year, the blue line shows the revenue that was actually available. So this was from the property taxes plus that 1 cent sales tax. And the orange, so the blue line's what's actually available. The orange shows what would have been available if they hadn't changed the law. So you can see the gap. So orange basically shows the gap in those two streams. And you can see that the gap widened considerably during the recession and then began to narrow over time, but still has never made up for the difference. So that increase in the sales tax has never been greater than what would have been collected via the property tax. And this has resulted in millions of dollars deficit across the state. More importantly, it has also resulted in very differential outcomes depending on what county you're in within the state. And this slide explains that. So if you think about it, you're eliminating the property tax for schools on owner-occupied home, but you're still able to tax properties that aren't primary owner-occupied homes for those purposes. So if you think about a place like Myrtle Beach, they have a lot of second homes there, right? A lot of rental property, a lot of apartments, a lot of commercial property. Those are still able to be taxed for schools. But there are other counties in the state where they don't have as much commercial activity, right? And certainly don't have as much second homes and other types of properties. So eliminating the property tax on owner-occupied homes hit the counties with less commercial activity, less rental property, much harder than it did places like Horry County, which is where Myrtle Beach is. So not surprisingly, those locations where they have mostly owner-occupied homes had to raise taxes on other types of property more so than they would have had to possibly without this change. And so I have two examples here. One is Allendale, South Carolina, or Allendale County. It is one of the lower income counties in the state, but I intentionally didn't pick the lowest income, but it is one of the lower income counties in the state. And then the other is Hilton Head Island, South Carolina, in Beaufort County, which is a very high income coastal part of the state. So one of the things you'll notice on here is I have for each place the owner occupied home, and I break down the appraised value of the house, the assessment ratios, millage rates, and then down to property tax paid. And I have that for owner occupied homes and then for non-owner occupied homes or commercial property. You'll see also that assessment ratios are different. So in the state, so owner occupied homes are assessed at 4%, while others are at 6%. So in Allendale, South Carolina, if you have a $250,000 house, your total property tax paid is $4,080. This is as of last year. In Hilton Head, if you had that same $250,000 house and it was owner occupied, your taxes would only be $1,321 a year. So a major difference. And you can see I have in there showing it negative what that homestead exemption is for the property from Act 388. Interestingly, and I've always found this very interesting as an economist, when you get your property tax bill every year, it shows it in that way. So it shows you how much money you're saving from Act 388. So it's very evident to homeowners how much they're saving. Non-owner occupied homes in the same counties are assessed at a higher percentage, and they don't get that homestead exemption from Act 388. So you can see that if you were if you owned a rental property that was worth $250,000, then your property tax liability would be $10,440 in Allendale, South Carolina, and only $3,692 in Beaufort County and Hilton Head Island. So very different tax liabilities across different types of properties or different ownership of the properties and occupation of the properties, and also very different types of liabilities across counties. So what's happened since then? Well, there are lots of legislators, I've spoken to many of them myself over the years, who readily admit that voting for this was a mistake. And I put 3 quotes here that I found from people who said, you know, I don't know that I regret anything more than voting for that. The problem, though, as you can imagine, is, you know, and I'll teach this to my university students when I'm teaching, you know, if you cut somebody's taxes by 50%, if you realize that's a mistake and you want to repeal it, you have to raise their taxes by 100% to get back to that initial level, right? Which is a problem politically, right? So even though people realize that this is extremely problematic, especially in the non-coastal parts of the state or other non-touristy parts of the state, like there's some places that have lakes and things like that, where also this has been okay, but in other places it's been very difficult. But even though they admit it's a mistake when presented with alternative proposals, all of which are going to raise tax revenues through either rate increases or expanding the tax base, they just don't seem to make it anywhere. And I love this quote from Bakari Sellers where it says, you know, probably pass somewhere between or around never wary, like it's just not going to happen. And so it's become a real issue across the state. You still hear it talked about a lot. You know, if you were to go to any sort of Chamber of Commerce meeting or certainly anything around education in the state of South Carolina, people there will know of Act 388 and be talking about it. So there have been several groups who've been asked to try to fix the issue. The first was the South Carolina Taxation Realignment Commission in 2010. They were actually told per statute that they could not consider Act 388 as they tried to realign the tax system because of the issues I just mentioned, because they felt like it was a political no-go. But they found that South Carolina is a low tax state, but it's also plagued with structural deficiencies. So the tax bases need to be expanded considerably. So all those sales tax exemptions I mentioned and some other structural issues with the tax system in South Carolina were found to be a problem. And they also commented on just how complex the system is in South Carolina, that actually if they would remove some of the complexity, they would actually raise revenues. And then recently, the Tax Foundation did a large report on this, and they looked at both sales and property taxes in addition to other parts of the tax system in South Carolina. But with regard to sales and property taxes, they found that they need to expand the sales tax base, get rid of some of those exemptions. Property tax should be better balanced across different types of property, so residential versus commercial, owner-occupied versus non-owner-occupied. That tax on commercial property, because they don't receive that exemption and the rates have had to be increased in a lot of places to make up for the Act 388 loss, you know, that has hurt our ability to be, you know, quote, business friendly within the state of South Carolina. And then they also found the assessment ratios on different types of properties should be narrowed. There shouldn't be significant gaps because of the inequities there, and that the reliance on personal property taxes should be reduced. Lincoln Institute Land Policy in 2020 is also making recommendations regarding property tax given the limitations around Act 388 repeal. You know, it's really easy to think like, well, we just need to get rid of this law, but if that's not possible, what are the things we might be able to do around that to improve the system? So is change afoot here? Well, in January 2019, the Governor Henry McMaster, the House Speaker, and the Senate President all asked the Executive Director of the Office of Revenue and Fiscal Affairs to create a new education funding model. We've had the same model here since 1977. And a big part of that is because we had that court case that was never really finalized, where people were waiting around to see what were the courts going to deem required, and it just never happened. And so the new proposed model puts all state funds under one formula instead of it being under two formulas, and that distributes to school districts on an equity basis based on local property tax wealth. Under that plan, there's 55 school districts that would get more funding from the state, but 26 that get less. Even though there's broad support kind of on the executive branch side of the state, there doesn't seem to be a lot of political will to pass it at this time. So two quotes I found here, one from a Republican and one from a Democrat, one saying, you know, I don't expect anything to be passed. It's too big of a decision affecting too many people. And then another saying it's not going anywhere fast. Once legislators figure this out, they should go to Washington and create peace in the Middle East. So I think that last quote just really shows how challenging it is to fix this this issue due to the large number of issues that exist in both the sales and property tax system. So I'll stop there and take whatever questions you might have.
So Laura, thank you so much. You crammed a lot of key information into a very short amount of time. Luckily, we do have time for a few questions. And the first question, which would apply to people in other states, is what do you think is the most important lesson that policymakers from other states should take from South Carolina experience?
Yes, speaking to experts on the issue and also legislators over time, I think one of the big lessons is not to move too quickly when you're doing some sort of massive policy change like this. The recommendation for this change did come from the business community originally, but there, in my opinion, was not enough research done on what the real implications would be. And I think also, we have this, and we're kind of going through this right now as we speak, we also have this thing that when the economy is growing and things are doing well and property values are going through the roof, we kind of get used to that and just think that's the way it's always going to happen. And so, to think like, oh yeah, if property values keep growing at X% a year, we're going to be able to make up for this loss by raising the sales tax. Well, yeah, but no, that wasn't what happened because of the recession, right? So, not all taxes are created equal when it comes to the stability of the revenue stream, right? So, moving from a very relatively stable revenue stream like property taxes to one that's less stable like sales taxes, especially in a state like South Carolina where you already have a narrow sales tax base. And at the same time taking away the most stable part of it, which was food, it was a risky venture. And so I think doing more research would have been beneficial at the time.
Well, thank you. That makes sense. Another question. As you probably know, restrictions on raising funding through the property tax often lead to efforts to get around those restrictions. Mm-hmm. I'm pretty sure that in South Carolina's case, I believe those efforts have included the use of impact fees. Can you speak to that point?
Yes. So this has become a big point of discussion across the state. There have been some school districts that have used impact fees to try to fill the hole. Most notably, one of the districts, I live in Rock Hill, South Carolina, which is south of Charlotte, but the city right north of us, which is right in between Charlotte and Rock Hill, is called Fort Mill, South Carolina. They instituted impact fees a couple of years ago now. It's $18,100 and some odd dollars per home for a single family home, and then $15,000 per unit on a multifamily property. And that's fixed, so it doesn't matter the value of the home. As you can imagine, if you wanted to build a $100,000 house in Fort Mill now, that $18,100 impact fee is a huge tax, right, as a percent of the value of the home. And so it's not surprising that there have been concerns about affordable housing and the lack of affordable housing and multifamily properties that are being built because of those impact fees. But because that is a fast growing part of the state, it has also raised a tremendous amount of money in the short term. So it has led many other communities to think about using that as an option. I will say too that there were challenges in court and it did hold up. It was held up in court. And so, I think over time, it'll be interesting, honestly, to see what happens to that conversation in the next little bit here with the current crisis we're in. But in parts of South Carolina, the population was growing so rapidly that, adding an impact fee was not going to slow down population growth enough to make a difference. So I believe will continue to be used in some parts of the state.
We'll have to continue to follow that. So Laura, I have what I call my magic wand question. So I'm interested, if you had the ability to take a single property tax or school finance reform action in your state today, what would you do? But given what you said about Act 388, I'm not going to allow you to repeal it.
Yeah, I can't repeal it. Okay.
Yes.
I can't repeal it.
No.
I think I would probably, if I couldn't repeal it, then I would take a look at the assessment, limiting the assessment growth and then doing the point of sale assessments. I think that does result in a lot of horizontal inequities. And so, as a good economist, I believe we should allow people to be as mobile as possible and kind of vote with their feet when they want to and move around. And so I do think that creates some inefficiencies across the state and a lot of inequities within neighborhoods.
Okay, well, thank you. Thanks so much for your time today, and thank you very much to our audience. In closing, I hope that you all will look for 2 other parts of our school funding property tax connection series, which are presentations on Texas and Wisconsin. I also hope that you will check out the wealth of property tax information that the Lincoln Institute has on its website, www.lincolninst.edu. Among other items are significant features of the property tax database and state-by-state property tax at a glance visualization tool and narratives will give you in-depth information on the property tax in each state. Thank you so much for your time.
Thank you. Thanks for having me.
Bye-bye.
Bye.